Welcome to our 30 June 2020 financial reporting update. Hi everyone, my name's Susan Oldmeadow-Hall. I'm a partner in our IFRS Advisory Services team and I'm here with Wayne Basford, and today we're going to run the financial reporting update with Wayne doing most of the talking. Before we start, I would like to, for all of those of you in Australia, I'd like to acknowledge the traditional custodians of the land and pay our respects to the traditional owners where we find ourselves, those elders past, present and future. Our session today is really interesting because we're going to be looking at the impacts on financial statements of COVID-19. And before we really get into it, I would like to ask you a question, and I'm going to launch a poll. Now, you will be able to answer the poll questions when they come up, and there's also a question and answer area. So as you have questions on the presentation, you can type your question in, and then at an appropriate time, I'll try and interject and ask Wayne to consider the question. And I'm very fortunate, someone's already sent us a question before the presentation even started. So thank you for that. And it does make it more interesting if we can hear what you're really excited about or what you want to know answers to, where the challenges are for your financial reporting. So I'll kick off with this poll. And that is, do you anticipate that preparation of your 2020 financial report will be more complicated because of COVID-19? And we just want to understand to what extent you think that is, or whether you think really it's too early to say. So if you could answer that question, and then once we've had that answer come through, I will close the poll and provide you with the results of that. And it's great. I can see the votes are coming through on this question. And it is interesting because you probably had a lot of emails come through on COVID-19 and what to look out for. And hopefully today we'll be able to give you a bit of a roadmap on where to look. And BDO has a lot of great resources for you. So that is always a very good place to start, is with our BDO website and our COVID-19 guidance. But also there's some really good guidance that's come out by the Australian Accounting Standards Board and the Australian Auditing Standards Board and the International Accounting Standards Board. So we will run through those sort of things too to help you with this. Now, we're doing very well with this poll because 77% have voted. So I'm going to close it off now, or just give you 1 or 2 seconds just to get those answers in. So I'll close that. And the polling results I'm sharing with you now. And do you anticipate that preparation of your financial statements will be significantly impacted? 18% said yes. 59% to a minor extent, 5% not at all. Well, you're the lucky ones, and then 18% too early to say. So I'm going to hand over to Wayne now. And Wayne, is that what you were thinking the results would be?
To a minor extent is surprising at 59%. And, you know, sitting here at the end of May with the June reporting season, looking at us, 18% too early to say is equally a bit surprising. So recognizing this is very likely what I believe to be the most challenging reporting season I think I've ever lived through. So
well, I'll hide the poll results and we can go into the slide, shall we?
Let's try that. Okay. So good morning, everybody, and hope everybody is safe and well. When myself and Susan planned our annual accounting update, it was almost, this is going to be quite boring. We've done 9, we've done 15. For most of the listed companies in the room, we dealt with 16 in the half year, and we were just looking at, going to be lessons learned from 9, 15, 16, the new interpretation on certain tax positions. And then it came to look at COVID. And I think for the last 3 weeks, maybe 5 weeks, very likely 3 times a week, I've been on international calls looking at various aspects of how do you account for this. And the more I put together these type of presentations or present them, the more of a challenge I think we're all under. And it's a challenge for directors and it's a challenge for their auditors. And both those directors and auditors are really exposed to risk. How can you actually prepare meaningful financial statements in the world we're living in? Obviously, the key topics: going concern impairment. You've got no revenue, your revenue is 20%, you're forecasting revenue down by 50%. Are you a going concern? Are your assets impaired? Some of you will have assets that you record at fair value. Now, in this market, what is fair value? What's the true fair value of investment property? What's the true fair value of certain financial instruments? So it's a whole plethora of quite difficult accounting topics in a very, very challenging time. So we've divided the session into 2. So I'm just really going to look at going concern and impairment in this session, and then Susan will deal with other issues of it, disclosure and getting through the reporting issues in tomorrow's session. Equally being aware, I know there's a number of attendees that are from the not-for-profit sector. We are running a deliberate not-for-profit session or 2 sessions on Thursday, Friday, if people would also like to enroll on those, because the challenges are also there, but they're slightly different issues. In case anybody's been living in a cave, we had a global pandemic announced by the World Health Organization on March 11th, 2020. And that is key when you're looking at December year ends. If somebody's still not lodged their December year ends, well, it's a non-adjusting post-balance sheet event until the 11th of March. But for most people on this call, obviously, it's June 2020 that we're dealing with, and emphasizing we are the lucky country, and we're definitely lucky with our number of cases and the control of the virus in Australia. But that comes our summers, etc. We have a June year end, so we're going to be the first country in the world in a full reporting cycle, major economy reporting on the 30th of June. So this is going to be a real challenge for us all. Obvious issues on coronavirus: going concern, liquidity. People are renegotiating debt, renegotiating convertible notes, issuing share-based payments to save cash, have problems with their customers are refusing to pay, people are renegotiating their leases, they're retrenching staff, they're furloughing staff. And even if you're in an industry that's not directly impacted, you've got supply chain issues. Can you actually get the materials you need from the suppliers, mainly China? And have you got the transport to get it to you, even if those items are being manufactured? When we look at, we'll focus in this in terms of the accounting, the financial reporting, but there are definite issues on, if you're an auditor, how do you attend the stock take in lockdown? Are your group auditors in lockdown? A key aspect of an audit, ASIC 315, is systems and controls. People have reacted amazingly quickly to the virus working from home, but does that mean that you've relaxed some of your key controls and key systems? a lot of this presentation, or a lot of the challenges for us all in this next reporting system, it's valuation, impairment of assets, impairment of receivables, new share-based payments, renegotiating your debt, impairing your property, plant and equipment, impairing your right of use assets, writing down your inventory, etc. Other issues, provisions, redundancies, onerous contracts, and there are complex accounting issues, and we'll deal with these tomorrow. How do you account for a lease modification? How do you apply a very complicated revenue standard, AASB 15, in these interesting times? And all of the government support, how do you account for that? Is it a grant? Is it a tax credit? Or is it something else? So, the impacts are very wide. Reduced customer demand for goods and services, lack of investment, construction being reduced, commodities, if you're oil, the commodity price is significantly down. Can you get your goods to market? Can you get the supplies you need from your suppliers? A big challenge for us all is, how do you actually account for an entity that's gone into hibernation? So again, Susan, if you can just run that poll to see, operationally rather than financially reporting, how much of the audience been impacted by COVID?
So we are running that poll now, and this is really, what is your business impact? Are you expecting a significant impact for your business or not? And, it's always interesting then to compare this to what you would expect with the financial statement disclosure. Wayne, have you got any comments on that? Do you think there should be a correlation between whether there was a business impact and financial statement disclosure impact?
I think it's going to be very, very key, and we'll touch on it tomorrow, disclosure and explaining and communicating the situation to your stakeholders is key to this. I actually believe a lot of this disclosure will be in your operational review rather than in your financial statements. But it was surprising, even last week, we ran a financial accounting update for the natural resources sector, which is potentially the least impacted of a lot of the major sectors. And even they were struggling, and they'd got significant going concern issues. So disclosing how it's impacted you, how lockdowns impacted you, not being able to work from the office, not being able to get people on site, not being able to go to construction sites, how it's impacted your order book is going to be key to showing this.
So we've got a very good audience. They're very good at filling out these polls. We've got 70% of people voting. So I'm just going to leave it open for another 15 seconds, and then we'll close the poll and share the results with you. So if you can quickly just get in those votes, anyone who hasn't voted, that would be great, because it's always good to get a broad perspective on these things. And someone has asked us to define significantly versus minor extent. So is a 30% reduction in turnover to receive JobKeeper considered significant? And I would say yes. Don't you, Wayne?
Absolutely. If you think real world, if we were planning audits normally and a client told us that they were forecasting a 30% reduction in turnover in the next 6 months, that would be significant.
Yeah, so I think for that person that's asking that question, can you hit significantly? And now we're up to 79%. I just want 1 more percent and I'll close this poll. We'll close it now anyway. We got 80%.
You do realise, there's lots of auditors on this call as well from around Asia, so I'd imagine they could all hit significantly as well.
Well, we've closed the poll already, and look, the results are coming in at much higher in terms of business impacts. We're looking at 50% of people saying significantly, 47% to a minor extent, and only 3% of not at all or too early to say. So definitely the business impacts, people are anticipating much greater than what they thought their financial statement impact would be.
But
So
Susan,
I'll hand it back.
that's a different percentage to people who answered the first poll, because I'd have thought though anybody that's had a significant impact of the virus to their business would almost be anticipating a significant challenge on their financial reporting. I don't recall a 50%.
No, only 18%. We had a significant and 59% to a minor extent. And then 18% were too early to say. So yeah, the polls are coming up quite differently, that the business impact is expected to be much greater than the financial statement reporting impact.
Which I find surprising.
Well, maybe you can change their minds, Wayne. I'll hand over to you.
Yeah, this will be the usual good cop, bad cop. So I apologise to everybody on this call for the next 40 minutes of depression and misery. So, as Susan mentioned, a very good publication that's come out jointly from the Australian Accounting Standards Board and the Australian Auditing Standards Board came out last week, and it's so apt because it does correctly show this interrelationship between the preparers, the directors, and the auditors, and the fact we're all in this together. So the key aspects as they set out in this paper: going concern, solvency and going concern, overview of going concern, disclosure requirements, impact of going concern on other areas of financial statements, what do you do if you're no longer a going concern, and implications for the auditor. So that paper very much focuses on going concern, and when they're talking really about other financial areas, it is obviously in terms of impairment and consistency between a going concern assessment and your impairment and determination of your recoverable amount. Noting this is a general accounting update, when you look at all those potential major sectors of the Australian economy, travel and tourism, arts and recreation, hospitality, charities and arts are obviously being significantly impacted, almost just then they're in hibernation. Professional services, we follow everybody, we count the beans, but if people aren't making money, it has a very, very quick impact onto professional services. Financial services, people have lent all this money to all these sectors that are no longer operating. Retail, obviously online's doing well, but I can't remember the last time I went into the Perth CBD to do any shopping. Manufacturing, back to the supply chain. So this was just a brainstorm of the major sectors that are on this call, and it's hard to imagine which ones of those that were not significantly impacted. Again, it's weird looking at these pictures. We've obviously using our stock photos, and so many of these stock photos as we go through the presentation are obviously pre-COVID. Too many of these are socially not distancing, nobody's wearing masks, and it's a real throwback to how things were 2 months ago. So this session, so the next 40 minutes, I will just really deal with going concern and asset impairment. I hope to look at financial instruments, but if we don't finish financial instruments this morning, then we'll roll it over tomorrow. So going concern, the whole bedrock of our financial statements, of application of Australian accounting standards, international financial reporting standards, is we are a going concern. And that message, the fact, the basis of preparation, you either are a going concern or you've got uncertainties about a going concern, or there are no material uncertainties, but it is a key element of preparation. And we've got 50% of people saying they were significantly impacted by COVID. You need to consider all available information about the future, and you must be looking at 12 months into the future when you're preparing that. This is a direct quote from that AASB paper. It's a fundamental cornerstone of preparing financial statements. And you get this weird one. If your company is not going to continue as a going concern, you can't really prepare it under as a going concern basis, and therefore you have to modify the existing accounting standards so as to be able to measure your transactions and record your transactions in accordance with those accounting standards, but technically you are not applying the going concern assumption. Assessment of going concern. What is the impact going to be? How are you going to look at what are your future cash flows going to be? Are you going to get forgiveness of debt, extension of debt, renegotiate debt? Are your landlords going to help you to renegotiate your leases, to defer your lease payments? And what is the knock-on effect? With all the unemployment that we're seeing, what is the demand for your products? For those of us that live on the back of transactions, what transactions are going to happen? How many IPOs, how many sales, how many acquisitions are going to follow on from this time of uncertainty? With a number of economies opening up, potentially bars opening up, etc., what is the likelihood of a second wave, a third wave? How are you predicting when the economy will open? Are you predicting the economy will recover via a V, a U, a Nike tick? And what shape of when we get to normalized cash flows? Everybody's got to look at how can they secure cash flows? What facilities have they got? When are they going to breach their facilities? What is the worst case? Are they being overly optimistic? Are you producing actual realistic first 6 months, first 7 months, and then a ridiculously optimistic hockey stick that by March we'll have recovered to the normal March 2020 levels or March 2019 levels? Is that realistic? Or will it actually take 18 months, 2 years to recover back to reasonable cash flows and stabilized cash flows? Going concern assessment, everything's going to rest around your assessment and your disclosure of your going concern. So what is your assumed liquidity positions? When will your sales pick up? Or in some cases, say the professional services, how long before your sales start dipping? And when we do go into these dips, when will these falls in cash flows start to recover? When we're looking at your disclosures, how long and the severity of disruptions to supply chains, when will you be able to get back on site? When will the retail operations open? When will transactions happen? The economy around the world, and including Australia, is dependent on government support. Government support is going to stop in September. What is your assumption as to whether they'll extend it, won't extend it, and what is the impact on that and your ability to continue as a going concern? Will you be forced to retrench staff? What are the cash flow consequences of retrenching those staff? And again, this is a quote from the AASB paper, and it emphasizes a very useful paper to read because directors have a responsibility for solvency assessment. So directors have, through COVID in Australia, been partially suspended from some of their solvency obligations, but every listed company on this call, your directors will have to make a solvency declaration, and they must be able to justify their opinion. And now, remarkably, as we sit here in May 2020, you've got those three ways of signing a solvency declaration. You either state the directors have reasonable grounds to believe the entity will be able to pay its debts when they become due and payable. There is a material uncertainty as to whether the entity will be able to pay its debts as and when they become due and payable. And the third one, the directors do not have reasonable grounds to believe the entity will be able to pay its debts as and when they become payable. Now, this is the director's solvency. So the directors can literally qualify as to whether they're solvent. But these items have a direct correlation to the basis of going concern. Are you a going concern? And the directors, although they can caveat and qualify whether they're solvent, when they're preparing the financial report, as I mentioned earlier, you have to decide whether it is appropriate to prepare the financial statements on a going concern basis. And looking at the way, what is this difference between solvency and going concern and the interaction between solvency and going concern? An entity is assumed to be a going concern unless management intends to liquidate the entity, cease trading, or has no realistic alternative to do so. So when entities are looking there with no revenue or significantly decreased revenue and debt to repay, lease obligations to repay, suppliers to repay, or some of their suppliers may have gone into trading problems, etc. Is that going to be a case there is no realistic alternative other than to appoint an administrator? Third bullet point, an entity may be able to pay its existing debts but needs to wind up its operations for other reasons, loss of a major contract. So you can have the situation where you're solvent, but you're not a going concern. Fourth bullet point, an entity may not be solvent but may elect to continue operations, and then directors may assess the going concern basis is appropriate. Very big decisions for the directors, the boards, and equally there's a very pressing issue with how this interacts with the auditor and whether they're happy to have an emphasis of matter paragraph referring to the uncertainties, or whether they believe the entity is not a going concern and therefore the accounts cannot state that they're prepared on a going concern basis, but rather that should explicitly state they're not prepared on a going concern basis. ASIC's regulatory guide. So when we're looking at the regulatory guide, where directors state there are reasonable grounds to believe the company will be able to pay its debts when and fall due, despite prima facie indicators to the contrary from the accounts, the directors disclose the reasons for that opinion in order to ensure the accounts disclose a true and fair view. The disclosure around going concern, the mitigating factors around going concern are going to be fundamental to this reporting season. And there is this issue, the interaction with 570. The auditing standard 570. So the auditors have to consider whether the entities are going concern, whether the uncertainties around going concern have been appropriately disclosed. There is an action within Australia that if the auditor believes the company is trading insolvently, that's a breach of the Corporations Act and needs to be reported to ASIC under Section 311 of the Corporations Act. Again, this is directly out of the AASB guide. The mere existence or possibility of mitigating factors may not be sufficient to conclude your going concern appropriate. So although you can write down remote chances of success, that you will find funding, that you will successfully get a rights issue, that you're looking to dispose of a business, that you're looking for new investors, that you're looking to renegotiate debt, if they're not realistic, even if you've disclosed them, it is not appropriate for you to prepare your financials on a going concern basis. For all of that, there are only 3 scenarios we end up with, especially in these uncertain times. So having considered all relevant information, management concludes there are no material uncertainties. So that actually solves being a disclosure in terms of 101 going concern. But this slide is deliberate because it is a key judgment. You actually have to disclose the key judgment that you've come to this issue and decided that you are not there are no material uncertainties, and then explain to people why you've decided that. You then get, having considered all the information, you decide there are material uncertainties and you list those out. And as the worst case, mitigating factors are insufficient and you've chosen to prepare the accounts on a non-going concern basis, and you're looking at not being able to avoid liquidation or cessation. Then we have the very challenging issue. The entity is no longer a going concern. What now? And you must disclose the fact, adjust the basis of preparation, and you describe the fact that you're not preparing the accounts under a going concern basis. And I'd caveat people, you shouldn't use the term, I've prepared it on a liquidation basis. Purist to liquidation basis would imply you're preparing the financials on what you believe would be the net proceeds from liquidation. That would involve writing assets up to their realizable value if you could sell them for more. It would involve providing for future losses, future operating losses until the entity is liquidated. Those 2 elements are certainly not compliant with IFRS, are not compliant with Australian accounting standards. So major issues if you do not decide you're a going concern.
So Wayne, we have a question, and if the directors are not certain about that they're solvent, but they're allowed to have this sort of safe harbour that ASIC is providing, does the auditor still have to do a Section 311 notice in this period regarding their concerns that an entity is trading whilst insolvent?
I believe so. Not a law. That is a legal action that I suppose all the auditors will be checking on. But as I got that slide from the AASB paper, it would still imply that, almost stating the obvious, because the directors have done the right thing, that they've actually done a solvency declaration. It will be more challenging, I suspect, that the auditor needs to come up with an agreement that the going concern basis is appropriate. So if the directors themselves and these are the directors that are signing the financial report. If they've qualified whether they are a going concern, it may be difficult for the auditor to agree that the accounts are a going concern. And I think that's going to be the bigger friction rather than the 311s.
And I've had another question come through, and this is around getting loans from related entities or having to pay lease payments to related entities. And the question is will they have to worry about going concern issues if the directors deem that the business is still a going concern even though they can't pay their obligations to related companies?
One of the horrible things people hear me say normally is it depends on facts and circumstances. So is it a related part, and you would disclose it? So you've decided that on short-term liquidity, you've been advanced funds of this, or that your landlord has, or you've not paid your landlord, your negotiations with your landlord, or a related entity or a shareholder has paid your obligations for you. All of that would have to be disclosed. And then, depending on very much facts and circumstances, how robust is that funder and how patient is that funder? And again, it would try and disclose behind that. And it's going to be an issue for the directors and for those auditing it. What audit evidence can you provide that would say that that level of financial support is going to be there for 12 months? Any more questions, Susan?
No more questions. So let's hit impairment of assets. Although I do have a question for you at the end of impairment of assets. Someone sent through one early.
Okay. So when we were talking about who was presenting, it was decided I'm the most miserable person between myself and Susan, so I would just deliver the bad news. Obviously, very much interrelated with the questions on going concern is impairment. Everything's to do with cash flows. We've had a fundamental shock with our cash flows. So looking at what is the flow-on effects of COVID, well, we've got all of these standards that actually deal with impairment. 6, 9, 102, 112, 128, and of course, the fundamental impairment standard 136. Goodwill must be tested for impairment annually and must be tested for impairment if there's been an impairment event. Same as PP&E should be tested if there's been an impairment event. Trade and other receivables is accounted for under AASB 9, but we have a predictive loss model. We change our losses depending on terms of whether the counterparty has had a significant increase in their credit risk. Inventory, can we sell it? Is there demand for it? Is it going past its sell by? Investments in associates, deferred tax assets, AASB 112, IS 12, you can recognize deferred tax assets if it's probable they were recovered, flowing on from all those going concern questions. How probable is it? We'll touch on AASB 15 tomorrow. We'll have all of these contract assets sitting within AASB 15. They're caught from impairment by AASB 9. The new lease asset, new world of AASB 16, everybody from the 1st of July put these right of use assets on their balance sheet when they adopted AASB 16. Well, they may be impaired now. A number of people will have financially guaranteed their subsidiaries, maybe associates, maybe JVs. Do those financial guarantees give rise to impairment or issues? So obviously the challenge, AASB 136, IAS 36 impairment. Said before, goodwill and indefinite life intangibles test annually. And then, of course, the other assets test if there's been an impairment trigger. Looking at paragraph 12 of AASB 136, external sources of information that might give an indication that indicates there an impairment, significant changes with adverse effect of the entity have taken place during the period. Looking back at our poll, 50% of people said there'd been a significant impact. Internal sources, particularly 12G, evidence is available from internal reporting that the economic performance of an asset will be worse than expected. Nothing's changed. This is an old standard. We've all been living with IAS 36 for a long time, but we now have to apply it in the most amazing sequence in reporting. We have the choice, value in use or fair value less cost to sell. It applies to your goodwill, your indefinite life intangibles, your right of use assets, your property, plant and equipment. And as we'll all be staring at, as very helpfully set out in paragraph 30, the following elements shall be reflected in the calculation of an asset's value in use: an estimate of the future cash flows an entity expects to derive from the asset, the price for bearing the uncertainty inherent in the asset. Estimating the value in use involves two steps: estimating the future cash flows and outflows derived from the continuing use of the asset, applying the appropriate discount rate. And as a reflective pondering, how many of us can realistically estimate our cash flows in the next 12 months? How many of us can actually estimate when lockdown will happen, whether the second wave will happen, how quickly we'll recover, etc. All the comments I made on going concern, they are so applicable in maths when we start looking at the value in use model. And a key phrase as to where we might see us all having to adjust our value in use models. And again, these decisions, we're having this conversation in May. It would be very useful if people start putting their mind to the modeling now rather than in September or October. So in applying paragraph 30, you either look at the future cash flows or a discount rate to look at the uncertainty within those cash flows. Paragraph 33, impairment of your cash flows on a reasonable, supportable assumptions that represent management's best estimate of a range. Base cash flow produced on the most financial budgets forecast approved by management. Estimate cash flows projections beyond is not allowed. So when you're actually looking at applying IAS 36, we're anticipating people may well use two discount models. So most of us now actually apply one forecast set of cash flows. We look at our budget, we look at our EBITDA, we adjust EBITDA, and we apply a discount rate to that one set of cash flows. I'm predicting the only sensible way to apply IAS 36 in a number of scenarios is actually to model out various scenarios. So we're anticipating that lockdown will cease by September, and there is an X percentage chance of lockdown finishing by September. We're anticipating that that we'll have a U, and actually sales will decline until March, and then it'll start to recover. And we anticipate the likelihood of that is this probability. There is another model that says, well, maybe it is a U, but a very, very flat shaped U. So we will anticipate bottoming out our sales in March, but we're not going to see a recovery, and we're going to actually see quite a long bottom, and then we'll come out of it in 2022 or something. And this is the way people are going to have to apply VIU to these impairment issues. The alternative, obviously, in 36 is to use fair value less cost to sell. But is there a fair value is determining fair value any easier than determining VIU in these interesting times? Inventories, it will get caught. Is your inventory getting obsolescence? Is it in the wrong place? You can't absorb unnatural overheads into low production. You can't keep on putting losses into capitalized inventory. Just reiterating, you get caught by impairment in your associates and JVs. Do you know how well that associate's performing? Whether you should impair the effective goodwill that's embedded into your investment in your associate or your joint venture. Income taxes. I expected this season just to be talking about your uncertain tax positions and application of interpretation 23. Now we're looking at how probable is it to recognize deferred tax assets? Can you support the fact you've got losses that are going to be recoverable? Will even your timing differences be recoverable? And when and if will you ever be able to use them? Financial assets. Obviously, if you've got anything other than trade receivables, you would normally, you're in the three-step model, you'll be looking at using the stage 1, stage 2, stage 3 model, whereby if there's been a significant deterioration in credit risk, you move it from a 12-month expected credit loss to a lifetime expected credit loss. In a lot of these situations, your loans to joint ventures, your loans to associates, your loans to subsidiaries, are you now moving to a lifetime expected credit loss? For those people that have got trade receivables and you've applied various models all based on your history of default, your history of segments, your history of collection, your history of them being overdue and relaying, that's how you created your expected credit loss, your prediction. All those models that people built and used correctly up until December 19, it's going to be really hard to justify that those models can still be valid. Financial guarantees, you've guaranteed your subsidiary, you've guaranteed an associate, then again, you're caught by the impairment requirements of AASB 9. You've got complexity. So looking at where we've got to so far in this presentation, going concern, going concern, going concern. You've then got impairment, particularly of goodwill, intangibles, receivables. As part of your survival plan, a part of your how I'm going to continue as a going concern, it is most likely, fortunately, that you'll go to your financiers and you will ask for rescheduling of loans, renegotiations of loans, and you'll be saying to them, if you don't give me grace, there will be no business for you to have security under. So we're expecting a lot of renegotiated financial assets and liabilities. When we're looking at complexity, as and when you renegotiate a loan with a bank, you renegotiate your liabilities, even renegotiating your loans with related parties, etc. Then you're looking at, is it a substantial modification, non-substantial? How do you account for it? Substantial, you de-recognize and recognize a new liability with all the complexity of actually determining what is the market rate of interest as it applies in these almost distressed times, or is it non-substantial and you wind the modification in the effective interest rate into the debt? Anybody in the call that's applied hedge accounting, always, even under IFRS 9, you have to have a highly probable transaction. You genuinely entered into FX contracts in order to have a highly probable sale, a highly probable purchase. Is actually the disruption in your sales stream, your cash flow stream, your production ability, does that disqualify you from hedge effectiveness? And will you have to do quite detailed reassessments of whether you can apply hedge accounting? So we've now come to the end. I'd imagine that's been, for those people that certainly on the earliest poll that said it was too early to decide whether there's a problem, hopefully it's allowed people on the call to focus where they need to think about. So we've dealt with today impairment, going concern, and a very, very high level view of the impacts of AASB 9. Susan will continue tomorrow with a lot more of the subsequent financial reporting issues. And Susan, have we any questions?
We do indeed. We've got two. So one of them is, how would you evaluate impairment of assets if no valuation is done by a valuer? And I guess the question as well is this the period to get professional valuers involved?
I think you're into the whole challenge of how do you value? And I'm with full absolute respect to my valuation colleagues and professionals, how do they realistically come up with a meaningful valuation at the moment? When you're looking at how a valuation is done, like and similar transactions would be a great starting point. Well, show me a transaction that happened in February, show me a transaction that happened in March, and that just is not in the world that we're living in at the moment. Then a valuer will most likely go to cash flows, historic cash flows, industry cash flows, and again, will that be meaningful? So, and again, putting an auditor's hat on, if a valuer can actually definitively give you a valuation of certain assets in this world we live in, would the auditor actually view that as a reliable expert? So I do think we're in challenging times. Susan will come, you'll deal with delaying reporting. And from personal observation, potentially those people that have got major valuation issues now, maybe the world will be better when we come to September. Maybe it'll be better in October and you'll be able to get more reliable valuation site. Maybe, for everything we dealt with, you write a cash flow now, a detailed cash flow, an approved budget cash flow. The boards had weekly emergency meetings to consider the cash flows. Would anybody like to believe that cash flow will be the same cash flow people are using on the 31st of August or the 30th of September? So I think I dodged that question, Susan.
I think you did. Another question came through. Did I understand correctly that most entities will have to have a key judgment in the accounts to explain why they are a going concern?
It's emphasising this double whammy that I'm actually anticipating a lot of entities will have. Certainly, we're looking at the polling results of 50%, that a significant number of Australian entities globally will have, we've prepared these financial reports on a going concern basis, but material uncertainty exists, and these are the key judgments in that material uncertainty. Now that will be under the going concern, and the auditor will then, under 570, issue an emphasis of matter, saying without qualification to our opinion, I draw your attention to note 1 that says there's material uncertainty as to XYZ's ability to continue as a going concern. The very technical area, and this is most definitely, if you fought tooth and nail with your auditor and eventually you've managed to convince your auditor there doesn't need to be disclosed material uncertainties as to your ability to continue as a going concern, and the auditor therefore doesn't have to have an emphasis of matter, then applying 108, it's a key judgment, and you should actually say, we have actually come to a key judgment that there are no material uncertainties.
So Wayne, I would have thought there's certain industries where it's more likely you would. For example, if you're an airline like Qantas, I would expect to say that they would. Whereas someone like Coles or someone who's manufacturing toilet paper, you wouldn't expect they're going to have a problem. So, surely it's also a bit industry specific.
It's very industry specific, but when you actually go through, and we did the webinar last week, which was on natural resources, which when I actually started presenting that, it was not necessarily, it's not a sector that you're likely to have going concern. And from recollection, we had a 37% of attendees said there was a going concerns.
It was actually 39%, yes.
So I'm not sure how many toilet roll manufacturers are on this call or how many producers of PPE. I think there's going to be a lot of debates about going concern. And remember, this is all judgment and risk, and we're all in it together. If the directors do not disclose material uncertainty as to going concern and something goes wrong, the directors have just put a big target on their back. And at the same time, if their auditors have concurred with the directors there's no material uncertainty and have not issued an EOM, the auditors have now put themselves with a target on their back. So it's a major issue.
You are being very positive today, aren't you? Let's have a look. Another question, and that is a government subsidy included or excluded in VIU cash flow forecasts?
I believe it's included. If you're staying afloat and you're getting cash flows in, you're getting cash flows in that are mitigating your workforce or are mitigating your rent. A cash flow subsidy in order to buy property, plant, equipment wouldn't be. Yes, it can be, but for anybody who's asked that question, would you like to tell me how long that subsidy is going to last? Because every time I read the press, it's unclear, and you can include it, but how long you're going to include it is going to be difficult. And as you come on tomorrow, there's going to be this question around the region: is it a subsidy or is it a tax element? And you would not include tax within your VIU predictions.
So that is the end of our questions, Wayne. And I think we've done very well. We've finished on time, or only a couple of minutes over. So do you have any final thoughts to ask people or to share with people before we close off?
No, I do apologise for being so depressing so early in the morning, but it is challenging times, and I would encourage people to try and enrol on tomorrow, because hopefully, Susan, you're going to be a bit more cheerful than myself. But thanks, everybody.
Absolutely. Well, I do hope you join us tomorrow, because we're going to talk about how you can deal with it in a constructive way, and what we would expect people to be doing, and how the financial statements, you can really deal with these issues that you're dealing with. But thank you for joining us today, and we look forward to catching up with you tomorrow. Bye-bye.